And we'll just wait to yeah.
Passing around the clock from the First National Bank Tower. This is KLE-KLP Jonesboro. We educate, we entertain, we empower. We're Jonesboro's community radio station. KLEK 102.5 FM.
Good morning, Jonesboro and Northeastern Arkansas. I'm meteorologist James Covington with your KLEK weather forecast. Skies will be overcast for every Tuesday, breezy with scattered afternoon showers, then around 61. Southwest wind 10 to 20 miles per hour. Remaining cloudy tonight, breezy with spotty showers, followed to 46. Northeast wind of 10 to 20. Overcast skies, breezy with showers, scattered thunderstorms. Some could be strong for Wednesday, around 62. Looking to sunny skies, cooler and less humid, highs in the mid-50s. Jonesboro's community radio station, we're KLEK 102.5 FM.
From Feature Story News in London, I'm Laura Lakin-Ishaward. Rescue teams are continuing the search for survivors following an earthquake near Turkey's border with Syria. More than 5,000 people are thought to have died, a figure that is expected to continue to rise. US President Joe Biden is gearing up to deliver his State of the Union address to Congress. To establish how much senior Chinese leaders knew about an alleged surveillance.
What's that fire files AI? What's that?
It's a note taker. It's something Shanquetta actually turned me on to, so it automatically just transcribes.
Okay. You
You
heard about that? What is it? Chat.
Yeah, I actually been playing around with it. It's actually fascinating. All right, and we're getting ready to get. So stand by.
Now time for community conversations. Program focusing on the people working to make while offering program are those of the participants, not necessarily reflecting the views of KLEK 102.5 FM, what's part of all minority applicants, or our underlying response.
KLEK 102.5 FM. Good morning to you on your Tuesday. It's February 7th, 2022. This is Community Conversations. Here, the winner is here in the studio with you, and this is our monthly Homeowners Corner topic brought to you by Mr. Corey Mills of Cadence Bank. And today, our topic is why your credit is important when buying a home. And a couple of things we're going to talk about today is the overview of credit scores and how they are derived, and the importance of good credit when purchasing a home. So definitely gonna be a lot of great information being presented today. So we'll just kind of start off. Welcome once again to the program. And your first point that you have on here is, what is a credit report?
Well, good morning, Mr. Kell, and thank you all for having me on this morning on KLEK. I'm glad to be here to get this thing back started. Happy Black History Month to everybody. It's going to be a great month. So y'all have a host of activities, and try to get that out in the community, man, and get some participation. But let's dive on into it. As far as today's homeowners conversation. So we mentioned credit reporting and how to overview the credit scores and how they derived and why the credit is so important when buying homes. So credit comes from three bureaus. You deal with FICO, and they deal with Experian, TransUnion, and Equifax. And those are the three credit bureaus that compile up data to get you a credit report and a credit score, actually. So those credit scores, where the credit report is mainly going to consist of any business or all businesses that have given you credit or loans, is going to put on that credit report the amount of each loan and the credit limit of each card. It's also going to show how often you paid your credit or loans on time and the amount that you paid, and any missed late payments as well as bad debt. So what we see on a typical credit score is what we're looking for in the mortgage industry. We're going to look at all three scores and compile those three scores and take the middle one. So if anyone has like a 7, 650, and a 600, we're going to use that middle score, which is a 650, regardless of the bureau. Now, some credit debtors, they may only look at one particular reporting agency. Like I know on our banking side, a lot of them, they look at just only the TransUnion, but in the mortgage, we look at all three scores. We compile all the data from all three bureaus, and we'll take that middle score to register your credit score for the actual loan qualification.
Okay. Now, why is it important to have good credit, especially in light of what you said about how all three scores are being taken into consideration?
Yeah. So what we're looking at, the bankers want to minimize their risk as much as they can. So first, we're going to get that by the scores. So if typically on a conventional loan, you're looking at about a 640 credit score can qualify you to get an actual loan, a conventional loan. Now you can go below 640 with an FHA, but it's going to be a little bit higher on your down payment, possibly if it's about 600 or below. So not only do we look at that score, we're going to look at that content, because what we look at when we're compiling that data, we want to look at your debt that's on your credit profile. We want to look at your income. So what we call is a debt to income ratio. So we'll take everything that's going out on installments, revolving credit or whatnot, and what we see on the credit report, we'll use that's going out on a monthly basis and calculate that as debt that's going against your debt to income ratio. So not only are we looking at the score, we're looking at the content on it. And also if we're looking at the late payments on it. So if you have some collections or you have some 30, 60 or 90 days, those are derogatory items that may cause you, not only if you have a good score, but it could cause you not to get qualified for the loan because you had too many 30, 60, 90-day late payments.
Okay. Now, what does it take to get good credit?
Well, good credit is going to consist of paying your bills on time. So how credit profile is looked up at or compiled is we're going to look at the payment history, the amount owed. We're going to look at the length of the credit history. We're also going to look at new credit and a mixture of the things on your credit. So that you're also going to look at the length of credit. I don't know if I said that a minute ago, but once we look at all of those, excuse me. Once we look at all of those, we're going to just compile all of that up, so how to get that credit score to keep it strong and consistent, just make sure you're paying your bills on time. Never, if you can, make a have late payments or have a late payment on your credit score, because that can tick to get your score to go down. Another thing you want to do is keep your usage low. If you can, keep your balances low, below your usage rate below 30%, because that will show that you're not maxing out your credit card. So let's say if you had $1,000 card, and the safe thing is to try to keep your usage under $300, just to get in good grace with the reporting bureaus. So they'll look at that and say, okay, this is healthy, 30% use rate. And if you can pay that off to zero every month, that'll help your credit score as well. Keep that credit score open. If you have an account, you're not using it, try to put $5, $10 on there just to keep it open, because once let's say you had a card I opened back in 2005 and I closed that card out. Now it's just eliminated, what's that? 17 years, whatever it is, of credit history because I closed that account out. So try to keep your card open as long as you can to show that you have a good credit history.
And I'm glad you brought that up, because I was just going to ask that what happened, because I've heard of that happening. People played off the card, and then the card they closed the account out, and then it actually ended up hurting them instead of helping them. So I'm glad that you brought that up.
Yeah. I apologize. That 17 was probably 18. I think my math was kind of off there, but yeah, it definitely will hurt you. So the length of that credit sums up a big portion of your credit profile. So if you can keep a card open, even though you don't use it, it's something that you put back. You want to say, hey, let me put this back because I don't want to accumulate any more debt. but make sure you keep that card open. Use it every now and then so that credit company won't shut your account out or don't close it out voluntarily.
Okay, and you kind of already talked about what the credit score is and how it's calculated. So what are some of the best practices to build improved credit scores? So there may be people who are looking at the home buying process or just wanting to fix up their credit in general, but they may have some of these derogatory items that you mentioned, and they may not have the first clue of how to get them off.
Okay. You would definitely want to, look at your credit report. They offer free credit reports on annualcreditreport.com, and that gives you the content that's on your credit. So you want to go into a situation knowing what's on your credit profile and knowing if there are any derogatory items on there. You want to get that taken care of beforehand. Now, how can you get that taken care of? There's credit repair companies out there, but if one would just take upon themselves to read up on some things, they could possibly get that done themselves. Again, there are credit reporting agencies out there. I mean, credit repair agencies out there that can assist you with that. So you just got to shop around and do your due diligence on who does what, because a lot of people pay to get that taken care of, and it doesn't move the needle pretty much on their credit profile.
And of course, it's best, like you said, just to stay informed and stay on top of things as you can. So now, why is it important to check your score?
Again, because derogatory stuff. I mean, things happen. I mean, in this world of technology and internet, anything can happen. Your stuff can get, your accounts can get hacked or anything, and you might been going on for a while, not looking at your credit score, and this stuff been on your credit profile, and you was unaware of it. So definitely want to get that taken care of. I have an actual credit alert monitoring system on my profile. So credit is something that's very, 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 very important because without it, you're going to liquidate everything you have trying to purchase stuff. So why not be responsible and disciplined enough to use your credit for your advantage to, again, I use my credit to get me points, cash back, especially in this economy right now. Every little bit helps. And when you have good credit profile, you have those perks of getting cash back and rewards and things of that nature to help save some money.
Okay, and I'm glad you brought that up because that's something that often hear talk about. You just say get your credit fixed up so you can get a house, buy a vehicle, or anything that you need, but not some of the other benefits that could come forward as well. So besides those perks, what are some of the other benefits of having good credit?
You'll get better car insurance. I mean, everything's good when your credit is good. Just like being healthy, everything feels right. So benefits of having that good credit. Again, it can even affect you're getting a job, so
I was just about to bring that up.
Yeah, your employers, they're going to run a credit profile on it, because if you're not handling your business on your end or being responsible with your affairs, financial affairs, how can a certain employer may say, hey, how can we trust this person with our business affairs? So again, it's going to help you save on items throughout life, car insurance, home insurance, and also employment.
Okay. Now, what is a good credit score? We've been talking about these credit scores. So what's a good one? Then on the flip side, what is a bad one?
Okay, so I'm kind of merged these both together. So a good credit score is at least about 640 to 660 for qualifying for a loan. Bad credit score is FICO considers a credit score to be poor if it falls below 580. And according to FICO, a person with a FICO score of that range is viewed as a high profile credit risk. So although the ranges may be dependent on credit score modeling, generally credit scores range from the 580 to the 669. They're considered fair credit. When you go from 670 to 739, that's considered good credit. And then you go from 740 to 799, that's considered very good. Then 800 up, you're excellent.
What's the highest
it could go?
What's the highest it could go?
850.
Okay.
Yeah, I believe it's 850. Now I've been hearing rumors of they're moving the goalpost a little bit and might try to push it up a little bit, but we'll see. We'll have to adjust if it happens.
Okay. All right, and does bankruptcy mean that I can never buy a home?
No. You can buy a home, but you cannot buy it right now. So depending on the type of bankruptcy and the loan product, whether it's conventional FHA, rural development, VA, you will have different timelines, what we call dismissal dates and grace period, or seasoning periods that you can get a home loan. So depending on the loan product, you might be waiting from anywhere. The guidelines change a lot. So it used to be 2-3 years on certain products. I read recently it was 84 months on something. So don't quote me on that because guidelines are updated since the COVID stuff has kind of declined down. So we'll just have to look at every scenario as an individual basis.
Okay, and something that's not on your talking points, but I think is pertinent to the discussion is how does student loan debt figure into this? Because you have some people that, they may have everything else in order, but, because they may have a lot of student loans that they find the process is still difficult.
Mm-hmm.
So how does that factor in?
That factors in on again, it varies by loan product. Typically, we may have to include, let's say if you're in a deferred loan situation where you don't have a payment plan set up to pay that off to zero balance over a time frame or amortization period, we may have to consider either 1% of that total balance of all student loans or 0.5% depending on the loan product. So let's say if you had 100,000 on certain loan products, we have to consider 1% of that, which is that's $1,000 a month. So again, that could affect you a whole lot. They can kick you out of your qualifying debt to income ratio. 0.5% of that may be 500, depending on the loan product.
Okay, so in a person in that situation, would it be best if they try to get on some kind of payment plan, even if it's the income based repayment plan to kind of help, recalculate how that would be considered by the bank?
Yeah, so what we look at, we'll tell most people look at it that, okay, if I'm paying 1%, that's $1,000. Why not negotiate something with whatever student loan debt I have, company I have, student loan company debt that I have, to negotiate something that's way lower. So instead of paying $1,000, I might can structure it to where I'm paying $150 a month till the balance is over with. But that's something that you have to go back and negotiate with that particular student loan provider.
But once that's done, then you all could take that, or any bank could take that 150 into consideration instead of the 1%, which would be 500 or 1,000.
Correct.
Okay. Well, this has definitely been great information. Any other tips? In fact, let's go to the Facebook Live, see if we have any comments or questions before we give Mr. Mills an opportunity to do a wrap up. All right, and we don't have any questions or comments on the live feed. So kind of anything else to kind of tie all of this together, or anything else that we may not have covered?
Well, we knowing, interest rates, everything, price housing is pretty high, and what we're seeing in the market is people is getting priced out. Well, we just couldn't afford it. So credit is very, very, very essential to your interest rate getting an adjustment. So the better your interest rate, the better your credit, the better your interest rate will be. So if you're thinking about, okay, this is the year I want to plan for home ownership or something I might want to do in 2 years from now, this is something that you definitely want to look deeper into, because credit is the first front line of, okay, what's on my credit? How is it going to impact my debt to income ratio? How can this credit score impact me getting a better rate on my mortgage? So looking at it to be proactive and prepare to get yourself ready for home ownership. Just start going into your credit, start getting your stuff together, making sure your income is going to be consistent. Been 2 years on that. Make sure your credit profile is strong and healthy. Want those scores. If you can get them, the higher the scores, the better. Also, you want to go into the situation, try to eliminate more debt, because eliminate the debt you have on your credit report will allow you to have lower debt to income ratio, which means that you can increase your home purchase. So with the rates being a little higher, which they're starting to go back down a little bit, and then the house prices higher, every little bit here, if that credit debt to income ratio is dropped a little bit more, that means that you can afford a little bit more house.
All right, so definitely great advice. And of course, as he mentioned, if you are starting to entertain the idea of that, never a good time to get started in the present. So hopefully that you all will take this information to heed. And Mr. Mills, I want to thank you so much for joining us today for our monthly Homeowners Corner, which we do this every first Tuesday of the month. And we just really appreciate all the great information. That's going to do it for this edition of Community Conversations. You guys have a great and blessed day. This is KLEK on 2.5 FM.
All right, take care.
All right, have a good one.
All right, you too.